Let's kick things off with economic trends and what's going on out there in the world that could lead to some potential danger zones. You're going to learn today how the market has surpassed an all-time high, where the best performing market sectors are, what's going on with the bond market, and why so many people are playing it safe these days. Too many people still believe that the market is down for the year when in fact it's actually up double digits, yet the bond market is negative, and the bond market has been negative for 2 out of the last 3 years. We're going to dive into what's going on with government spending leading to excessive inflation. Even though reports are starting to moderate, inflation is still a major problem. We're going to talk about danger zones in real estate and why there could be some real issues burning and brewing within the real estate market. We're going to go into all sorts of discussions about where the economy is going, not only in the short term, but in the intermediate term, maybe deal with some of the election issues and surrounding issues. And we're going to answer all the questions you might have about how to stay invested and harness your wealth. Let's jump in. Hey, sports fans, it's Billy here. Welcome back to Harnessing Your Wealth. Today, I want to talk a little bit about the economy. We're going to stay on the economy and what's going on out there in the world. I'm going to really tune in on the positives and then maybe dive into some of the potential danger zones that are lurking in the shadows that I think could possibly derail some of this economic activity. In a way, the Federal Reserve is trying to engineer a soft landing, and oftentimes they overshoot. And of course, that has dangerous implications for any type of election year when you have a sitting president. Of course, they would love a soft landing to be put together and keep this economy trucking along. However, we all know that the effects of inflation have been devastating in a lot of ways, and it's going to be a difficult proposition. So let's talk a little bit about where we're at and where we're going. So to start this off, I want to talk about maybe some of the milestones. And the big headline grabber is Dow 40,000. Now, when I started in this business, the Dow was in single-digit thousands. It was 1,000 or 2,000, and moving up to that. And I remember when it reached 5,000, and that was a big deal. And somewhere back in those days, there was a book written. It was called Dow 20,000, and that seemed like a complete fiction. That was, a lot of people just blew that off as it was never going to happen. Nonsense. But I told people, even back in those days, early in my career, that, look, prices go up over time. And of course, we're going to see a Dow 20,000. It just seemed like such a stretch to get there. And we, of course, got there and went past it, went past 25,000 and then 30. And here this week, we went through 40,000. Now, of course, we're going to have pullbacks. And of course, you could see the Dow, if you think about it, a 50% correction would take us all the way back to 20,000. I'm not projecting that, but I'm saying anything like that is possible. We've had those types of corrections throughout history. It would be a major economic consequence and major problems in the economy in order to trigger something of that magnitude. I'm not expecting that. Any kind of 5% or 10% pullback is very common and to be expected. We already had a 5% pullback this year. It actually approached 7%, and the market has recovered since then. And it's surprising to most to know that the Dow has set 23 new all-time highs this year. So it's just one after another. And sometimes people get short-sighted and say, hey, the market's at an all-time high, I'm getting out. It's time to sell. But the market just keeps trucking higher. The reason it goes higher is because of earnings. And when earnings are positive and continuing to grow, the market prices continue to follow and keep up with that earnings growth. The S&P 500, the other major index that is more widely followed than the Dow, is up 11.5% year to date. Some of the sectors, I think it would be interesting for us to take a look at. Sector performance year to date. The best performing sector, maybe no surprise here, communication services, up 21.5%. So those are your, more high-tech companies. Those are your Microsofts Those are your Alphabets, Meta. They have a new acronym now for these companies called MAGMAN. It's pretty wild, but let's see, Microsoft, Apple, Google, Meta, Amazon, and the newcomer, NVIDIA. NVIDIA is taking the world by storm, by the way. They are the most prolific company in the market right now with their artificial intelligence dominance. Other sectors, technology is up almost 17%. And then you go down the line, energy's had a great performance this year, up 11.5%. And we kind of slide down and we look, what's the worst performer this year? Well, that happens to be real estate. No surprise there. We talked about this. I forecasted real estate was going to have a tough time. A lot of people have heard me say this over and over again. And I do believe that the pieces are setting up for real estate to struggle, especially in the commercial real estate area. I think there's going to be some pain and suffering, and there's a consequence for some of the things that have been done in our economy, set up by our fearless leaders. I'm going to go through that in a minute. But sectors, staying pretty strong. The S&P, like I said, is up 11.5. But where are we at, and why did we get here? And a lot of it has to revolve around inflation and the inflationary factors and what makes up the costs in our society. People are investing in the market more than they ever have, but more than that, they're investing in money market mutual funds. Money market funds are at an all-time high. The value of money in money market funds has exceeded $6 trillion today. And some people feel really comfortable getting that 5% return. However, they're, for the most part, unaware of the net return, which is still maybe barely breaking even when you factor in inflation. Still hovering 3.6, 3.8, depending on some of the different measures we look at. But core inflation is still nearly 4%. It's come down, but it's not like negative prices. Prices are still growing at that level. So when they say inflation's come down by 50%, that doesn't mean prices have come down 50%. Prices are still going up, just not quite as steeply as they were before. And I think we've all noticed that. It's shocking sometimes to go to the grocery store, go to the meat market, go to a restaurant. Heck, I took my family out to just get an easy dinner one night. We're out of a softball tournament, and quick dinner, go to Five Guys. There's 4 of us. So for 4 of us, it was $65 for a burger, fries, and drinks. Okay. That's going to be painful for a lot of people. And I've said before, inflation is a regressive tax. It hurts the lower income folks much more than the higher income people. Now, wages have tried to climb, but they have not stayed in tandem with the rising of costs and services, things that we all need to get by. So why are people glued to money market funds? Well, I think it's just such a shock and such a good feeling to think that I can get 5% versus where it was for so many years on these money markets, maybe making 1 or 2%, and still CDs, and people are looking at those and thinking, heck, I can get a money market fund for 5%. But then you take the cost of living out, 4%, and then pay taxes on the money market fund. And again, you're barely breaking even. So you can go with the 11.5% return on the S&P, or you make 5% on the money market and pay taxes on that, by the way, that year. Your gains in the S&P, you don't pay tax until you sell. And in the case of an IRA, you don't pay taxes until you take it out. So, of course, weigh all those things when you're thinking about your financial situation. But I want to talk a little bit more about inflation and how that affects real estate. So there's some issues brewing, as I mentioned, for commercial real estate. And let's talk about why. Some of the trends that developed from the pandemic response were a mentality of let's work from home. And there's still a lot of people that demand that. And there's still a lot of employers who are making room for that, allowing that. I felt like it was going to kind of come back. It has come back a lot, but statistically, there are still 30% of people, or 30% of the work is being done from home versus just 5% pre-pandemic rate being done from home. So what does that mean for commercial real estate? Well, it means less and less businesses are going to need office space, right? They don't need as much. Matter of fact, 18% of office space is vacant currently, and it's climbing. We get these numbers month over month, quarter over quarter. It's climbing. And there's other reasons behind that. We've got huge increase in mortgage rates. Obviously, everyone feels that pain. Try to go buy a new home right now, and then you start looking at the bank rates and you start looking at your monthly payment, and it has forced a lot of people to just take that off the table completely. And it's really painful if you're trying to sell a home that you had locked in a very low rate and then buy a new one at a much higher rate. People are just staying where they're at. So also a big problem in that vein is 20% of the commercial real estate loans are coming due this year. This is a big number, when you have that much money going to be resetting and be forced to engage in a new loan at a higher rate, that's going to cause some ripple effects. So business owners, CFOs are examining what they want to do here. When these loans come due, do they want to re-up? Do they want to go purchase a new property or new mortgage on that property? Or maybe decide we're gonna rent, lease, we're going to sell that one building, sell something off, if they could. So I think that the prices are going to be coming down and going to be pressured because there's going to be more properties that are vacant or potentially on the market. Of course, supply and demand, we all know how that works. It's pretty easy. That's why we have inflation, is there's been a huge surge in the amount of money in this system. And that's what led to this devastating inflationary impact for all of us to deal with. And we're going to be dealing with it for many more years to come. So again, office rates are becoming more vacant, commercial loans coming due. There's been also another reason why businesses are starting to shut their doors is a massive increase in vandalism and theft throughout the country, major cities, some more than others. I'll let you read between the lines on that. But that also leads to a bigger problem for this real estate market we're in. Regional banks are the ones that could be facing the consequence here, because 44% of regional banks have their asset portfolio tied to commercial real estate. 44% of their loan portfolios. Compare that to the larger banks, where they only have 13%. So it's a pretty big hit to earnings on bank portfolios. Now, we saw this a year ago when you had a couple of the regional banks starting to fail, and we had a complete exit or a panic mode from many of these regional banks by the depositors. Silicon Valley Bank comes to mind, and Signature Bank was another one that failed, had to be bailed out by New York Community Bank. But now here in February, New York Community Bank just issued a huge write-down in their earnings and their asset portfolio. Something in the ballpark of $200 million, I believe. And that was because the real estate values have come down and their loan positions need to be restated. So I think that might be just the tipping point some of these banks are going to experience. There's some other reasons last year. We felt like we got through that because there was such a huge increase in rates by the Fed. It was the steepest increase in rates in the history of our country. And that was because of all the money that was just printed during and after the pandemic. Why did they do all that? Well, it was because they shut everything down, and then the panic ensued, and then they couldn't figure a way out of that problem. They created a problem almost that wasn't really there. They exacerbated the problem, and then they caused an economic collapse. And then in order to get themselves out of it and save face, they printed trillions of dollars. And so everybody was applying for that in these PPP loans. And I have people, and I won't name names, I know people, friends, associates, who received tens of millions of dollars during that period of time and never needed but a fraction of it. But it came. So, if I know 10 or 12 people like that, how many do you think are across this country? Now that we're even finding out there was a huge amount of fraud that went on. We're talking billions of dollars in fraudulent activity that the government paid out. I always like to remind myself and people that I talk to, when the government decides to spend money, that's not the government's money. That's our money. They took it from us. They taxed us in some way, shape, or form, and then decided what to do with it. And it's more frustrating than ever when we look at the political landscape and realize a lot of the money being spent is nothing more than trying to gain political favor and trying to gain votes. And of course, we're in an election year, so everyone's going to talk about giving money to everyone in order to build up that good feeling, that good vibe, try to garner more votes for the upcoming election. So we're talking about all sorts of things in that more spending, more printing of money leads to more inflation. So we're trying to get out of inflation by raising rates, and they're trying to talk about cutting rates and engineer a soft landing, yet they keep spending more money. The more money comes on, shipping it to Ukraine, or we're going to increase our allocation to help a lot of these students with their loans or their student loan debt. And we're talking now $160 billion that we're going to issue to students who were unable to pay off their loans. Now, I know I'm walking a fine line here, but I can understand both sides of this coin, but I've always been one to say, take care of your own business. That's just the way I run my life. I don't believe in this social risk where other people now can feel like there's no risk to me. I can go out and take any loan I want, not really have a game plan for paying it back, and somebody's going to bail me out. People get really upset when they hear about banks doing that same kind of thing. Banks with their social risk programs, they loan money everywhere for their own profits, and then they need a bailout when things hit the fan. It's the same concept. Government bails them out. Now the government's bailing students out. And we're continuing to foot the bill for it and build up further and further inflationary trends. So that's a couple of other points that I wanted to make of why we're staying in this spiral. Switching gears just a little bit, where are the components of consumer price index? Now we have two different measures of that, the core and then the general, or the core and then the X food and energy. Now, transportation services year over year bears the highest burden on us as consumers. Transportation costs are up 11.2% year over year. So shipping, you want to ship anything, and I've recently done this, trying to buy some new office furniture from Texas and see the cost of what it is to ship that stuff over here. That's almost as much as the furniture. Then for shelter, so this is just your prices of your homes or apartments. Costs are up 5.5% year over year. And energy up less, but still up 2.6%. The interesting part are the vehicles costs have come down. So new vehicles are actually slightly down year over year. And then used cars are down a lot. But they had that huge increase, so they needed to come down on the prices. So actually used cars are down close to 7% year over year. But still, the bottlenecks are apparent. You go out there, and if you want a new truck, for example, you're still talking about a year time frame to get it built and sent to you. There are still these bottlenecks that carry on from the lockdowns and kind of a reworking of everything in our society. The effects are going to continue for a long time. Let's talk about debt. Consumer debt, excluding housing, is at an all-time high. This is a bit scary to me because we are spending more as a society than we've ever spent. And I want to make sure that people understand the consequences here because it's becoming a problem. 8.9% of credit card debt is delinquent now compared to the 10-year average of 5.9%. So that's a trend that is not a good one. Credit card balances, this will scare you. Credit card balances total $1.1 trillion in our country, which is 13.1% higher than just a year ago. And again, the student loan forgiveness plan now totals more than $160 billion. Now, that doesn't come close to the total amount of student loan, but the amount of money that the federal government's going to print or send to that issue is, again, $160 billion. Now, you think about, do we have the money to do these things? They make it seem so simple, they being the politicians and, of course, the president. It's so simple. We need to pay for all these things, and we have all these plans, and we're going to pay for them. But where is that money? Is it there? Is it in a war chest? Is it in some sort of a slush fund that the government set up for these types of ideas? Heck no, it's not. We're running at $34 trillion debt right here in our country. We are paying more in servicing the interest on the debt than we are paying toward education for young children. Is that scary? It is to me. And there's no solution really being talked about. There's no conversation being taken seriously. Why? Our political system is the problem, the root cause of all of it. Politics take over everything. And one party wants to undermine the other party, and they all want everyone to be happy, and they all want the votes, of course. So no one does the hard work. No one does what's really, really necessary, right, to right the ship, let's say. They just continue on sailing the same direction we've gone because they don't want to disrupt what could be a re-election or their time in power. And it's the same thing right now at the border. I can go through a lot of things, but it's all about the votes and garnering more votes. And if you're having a hard time grasping this or you're rolling your eyes, I just ask you, just take the blinders off for a bit. Don't listen to everything you hear on the news media. Understand what's going on and just ask questions. Why is this happening? Who benefits? Where's the end result? Why are we doing certain things? And you start peeling it back and start understanding a little bit more. It's the political system is not pretty, and there's a lot of corruption going on. Now let's talk about some things that might hopefully bear some positivity here. I don't want to be the bearer of bad news all the time. I just want people to know the issues in our society and our economy. Consumer net worth is at an all-time high, along with the debt. So I think that's a positive trend. And the wealth effect is creating more spending. Now, that's both good and bad. We want our economy to be strong, and it's strong because of consumer spending. Why is it strong? Why are people spending money? Well, a lot of it is because of this so-called wealth effect. When people look at their statements, their 401ks, their brokerage account, their IRAs, and they see them growing, and they see they're up 20% year over year, and they feel better about their financial health. So they're more apt to go out and buy that new patio furniture or go on a vacation, buy a new ATV. There's certain things that people do when they feel wealthy. However, when the values start to turn and go down, the opposite holds true. Right now, there's 62% of Americans are invested in the U.S. market. That's the highest level since 2008. Now, we all know what happened in 2008 when we had the real estate collapse, and then, all hell broke loose with almost every asset class imaginable. I don't foresee us going through another one of those. We had speculation, rampant speculation in housing. We had banks lending money to people that they never should have. There was no oversight. Even the government bodies that were tasked to keep banks from doing things with a lot of risk that could bear a lot of problems, they failed. So banks had to reset all these loan values when real estate started to go down, and it was just a falling of all the cards. And some people saw that, and it took a couple of years for them to look stupid because they predicted it, but the markets just kept going up. Real estate values just kept going up. And a lot of people smiled and laughed, and there's even these sophisticated, smart, Ivy League educated folks who worked for these big Wall Street banks and brokerage firms just thought it was never going to end. But of course, everything ends when it gets stretched too far. And that's what I don't want to see happening with this market. The market seems fine as it stands now, as long as earnings are continuing to grow and we have participation and we have jobs that are holding steady. People feel good about themselves. Wages are going up. Not for everybody, not for every industry. I think the people on those lower income jobs are really struggling to make ends meet right now. But we need to watch things, and we need to watch the trends out there with the shopping, the dining out, the vacations. Right now, I haven't seen a much slowdown in the trends with consumers. I spend a lot of time at horse sales. I spend a lot of time watching people and the prices of things in that industry, and I have not seen much of a slowdown, if any. Matter of fact, prices are continuing to increase. So that tells me we haven't conquered inflation yet. And that's what we need to get past. We need to figure out a way to get past that. People were very, very sure that the market was going to benefit from the Federal Reserve cutting rates. I remember the conversations last year in October, November, December. All of the economic forecasters, the big names out there in the world, were predicting the Fed was going to cut rates by February and March. And it was going to be multiple. It was just me on a regular monthly cycle. Every time they're going to have a Fed meeting, we're going to get another 25 basis point cut. And hey, we're back. Of course, that didn't happen. And we said that in our videos. Go back and watch them in November. And no way. Matter of fact, we said they need to raise one more time. And that didn't happen. So there's games that are being played. I think, again, going back to the political landscape, political games, I am much more open with my eyes on how things are working in our economy and with government bodies. And what's out there, why are they doing certain things? I think we all need to be paying attention to that. Now, we here are involved in all of those decisions for all of our clients. There are certain things that we've done and are positioning for. I think the markets are going to truck through this. There's going to be some areas that are going to be more difficult than others. But as I mentioned, household net worth is at an all-time high. We're sitting at $156 trillion in total net worth for households here in the country. You think about that back in 1990. The total household net worth was around 30 trillion. We're now at 160 trillion. That's a big increase. And a lot of that is, stocks and bonds, and of course, real estate. But the key is to know where trends are going. We're going to see, obviously, peaks and valleys. We're going to see ups and downs. And that doesn't scare me. It's just making sure that you're aware. These corrections in the market should be should be met with positive approaches to take advantage of it, like dollar cost averaging or allocating more money when prices come down. What areas do we like in the market right now? We like energy and energy services. We like consumer staples, the more traditionally defensive type companies like your Costco's and companies that actually produce things that people are really going to need no matter what the economy. And then communication services. So we're really positive on the artificial intelligence. Even though the prices are extremely high in that space, the earnings are going up even faster. I think this is a game changer here with the artificial intelligence. I think technology is here to stay. It's going to change a lot in how we interact with one another and how we live our lives. So anyway, until next time, I just wanted to make sure I was telling you about a few things in the economy, some of those danger zones that people may have forgotten about, gotten complacent. The markets can come down. Don't panic about that. Don't live your life worrying about what the market's going to do. Just live your life. The markets will take care of themselves. Now, it's what you do in reaction to that is the most important. So thanks for listening today, and I'll talk to you again soon. Signing out.